In response to the financial crisis in 2008, central banks around the world have engaged in unprecedented stimulus, bidding up asset prices to record levels while driving interest rates to generational lows. These conditions have created unique challenges, particularly for investors concerned about the risk of future asset bubbles and inflation, as well as savers who require current income. So where do long-term investors now look for guidance in post-crisis markets? For many years, investors and researchers have closely studied the investment approaches of the nation's largest and most successful endowments, such as Harvard and Yale. These so-called super endowments, with assets in excess of $1 billion, have been adept at translating ivory tower academic theory into real-world investment gains. But while valuable, there are limitations to this type of analysis, since individual investors differ from endowments in many important aspects, and therefore can't perfectly replicate the way they invest. However, we certainly can learn from the top endowments. We simply need to combine what makes these endowments successful with sound personal financial planning and investment techniques. That is how we created the household endowment model. The success of super endowments can be explained by their ability to incorporate three important elements, or pillars, into their portfolios. The process begins by deciding what asset classes to invest in and how much to invest in them. Super endowments deploy wide diversification, assembling a variety of distinct investments that behave differently under a range of economic and market conditions. They create a diversified core or strategic allocation that includes both traditional and alternative asset classes. We call this first pillar of the household endowment model the steady allocation, because it will tend to only change materially in response to significant changes in an investor's long-term goals. The next step is tactical management, setting aside some portion of the portfolio that is able to play offense or defense in different market environments. While it's not possible to time any market, it's important for investment managers to have the flexibility to reduce risk exposure in prolonged bear markets in order to minimize large losses, particularly since individual investors don't have an unlimited time horizon in which to recover. Super endowments are also often willing to adopt a patient, contrarian approach by adding to the most out-of-favor asset classes in their core allocations through regular rebalancing. This kind of fine-tuning or tactical management is the second pillar of the household endowment model, the ready allocation. Finally, the top endowments also try to improve long-term performance through the selection of active managers who have consistently demonstrated investment skill. We refer to this final pillar as the heady allocation, combining multiple traditional and alternative managers who stand out from the crowd over time through security selection and whose strategies often have little overlap with each other is also an important way to reduce portfolio risk. Many investors share the same basic goals as the nation's leading endowments, generating income today without sacrificing tomorrow by outpacing future spending needs and inflation. You have the opportunity to bring all three pillars of the largest endowment's investing strategy, steady, ready, and heady allocation techniques, into your home. Talk to your financial advisor today to understand how the household endowment model may be applied to your portfolio.